Welcome to the webinar. Thank you all for coming. This is the third webinar of this series, and we are very excited to present our audience with another book we have chosen to be on our book list. Today we'll be discovering a book titled Elliott Wave Principle, Key to Market Behavior by Frost and Prester. Joining the webinar will be Jim Martens, Elliott Wave International Senior Currency Analyst. We have the link to the book section at fx3.com. Perhaps Maud can help me with that link during this brief introduction. I have it here on paper. For those who are interested in studying Elliott Wave, the book is not very large. It's very concise, and it contains all the rules and guidelines of the theory. It also contains an excellent chapter about Fibonacci. Like with any sophisticated theory, practice is mandatory. And here is where someone like Jim Martens can be of your help. It's when you have someone analyzing price structures and counting the waves and explaining the trade setup that you start integrating the theory. It was when I had to learn Elliott Wave in depth for the MTA exams, the Market Technicians Association, that the theory really impacted my perception and understanding of prices and markets. The different personalities that a market can exhibit and this oscillation between them, the importance of the waveform, the fact that a certain waveform emerges in all time frames, the fractal notion of prices. All these inherent aspects of the theory are excellent foundations if you want to succeed as a trader or as an analyst. Explaining price behavior in Elliott terms is always very enlightening. For instance, how frustrating can a sideways market be if you don't know how to structure it? Did you notice when price retraces in a very sharp manner and then just starts to whipsaw and you can't measure for how long? Well, the Elliott Wave analyst will know that there is a high probability that if a 5-wave impulse is sharply corrected to a meaningful level, the market may start to meander up and down in order to gain time before resuming the trend. And this is just an example. These are the theories that make sense. Those who provide you a panoramic view and at the same time a detailed snapshot of what is happening right now. Elliott Wave is also about probabilities. It tells you the most probable scenario at any moment. And that's pretty much what we need as traders. All right, I'll give the mic to Jim Martens. We'll explain a lot more about his work, about the theory, and so on. Welcome, Jim.
Thank you for having me, and thanks everyone for joining us. I have a lot of material, so I'm going to jump right on into it and talk about what the principle is and what it is not. Most people think that the Elliott Wave principle is a forecasting tool. In reality, that's not what it is at all. As was just mentioned, it's a description of how markets behave. Once we have what I mean by that is they follow a set pattern, and there's just a small group of patterns we're looking for and one overriding pattern. And if we can identify where we are within that pattern, then we have a good idea of what should happen next, and maybe several moves from now. Thinking like a grandmaster in chess might think. Their skill is being able to figure out if I make this move, my opponent most likely, statistically, will do this move, I'll do this, he'll do that, and 10 moves ahead, checkmate. And that is very much how the wave principle works. So I already mentioned that there are patterns, so let's start with the most basic. This is a 5-wave movement. We call it an impulsive wave or motive wave. When a trend is advancing, you will see rises in 5. So if you're in a bull market, advances will unfold in 5 waves. If you're in a bear market, declines will unfold in 5 waves. Let's just say that we're following a market that has been declining for a long period of time. And suddenly, on a chart, and it can be any chart, because the Elliott wave principle is fractal in nature. So let's just say, as I'm often looking at a 15-minute chart, you see this on a 15-minute chart, a 5-wave movement from a low. That would signal to me that the market has turned, at least temporarily. And once I have a 5-wave movement in place, I should see a correction. This shows a correction. It's in 3 waves. That's the most basic form of a corrective pattern. You will see that when we get into other forms of corrections, or not other forms, but other sub-forms, that they all maintain a 3-wave shape. So now, continuing with the example, we have a 5-wave rally. Again, this is a 15-minute chart. There's a 3-wave setback. It does not go to a new low. That's a correction. And you'll see now, look to your left at the shaded area of the chart, what we just looked at before became the first and second wave in what develops into a larger 5-wave movement. And perhaps this is on an hourly chart. So there's more data available. We can see the subwaves. So we're seeing on 2 degrees of trend. Remember, think fractals. On 2 degrees of trend, we have 5-wave advances, 3-wave setbacks. So now some time has passed, and we have, instead of just 1 and 2 in parentheses, those 2 waves are the first and second wave that has developed into a larger 5. And in this case, I've put a 1 in a circle, just to designate that a larger degree wave trend has finished. What should happen after any 5-wave movement? Well, just as was the case before, there should be a correction. And on the left-hand side of the chart, you can see an A, B, C, remarkably similar to what you see over on the left-hand side, just of larger degree. Now, where folks might get a little confused is you'll notice within the ABC, the down waves are in 5, and the lone rebound, wave B, is in 3. Well, that's because if we drew a line down the middle of the chart, dividing the rally from the pullback, and only concentrated on the right-hand side, the trend during that time is to the downside. So the downward legs are in 5, the rebounds in 3, corrective, and then down again. But then when we look at it in its entirety, it's in 3 waves, signifying that it is a correction. It corrects the prior 5-wave advance. Now the shaded area on the left is the data that we just looked at. And you can see that if we carry this far enough in time, we can often see that same sequence. Here's that 5 and 3, another 5-wave rally followed, another correction, another 5-wave rally. So all in all, once again, we have a 5-wave movement. The question I always ask myself is, after a 5-wave movement, what should happen next? And the wave principle tells me there should be a correction. And again, here it is. A in a circle in this case, B in a circle, C in a circle. After a correction, what should happen next? I'm sure you have the idea by now that we would expect another advance. What this chart signifies, though, with all the subdivisions, and we could go lower in time and higher in time, is that the market is always unfolding in these 5s and 3s. And instead of just noting them on one time frame, say a 15-minute chart, I'm following them throughout the day on multiple time frames. I might have a 15-minute chart set next to an hourly chart. And I always start my day, regardless of the time frame I'm operating in most of the day, by reviewing my daily chart. What is the overriding trend? Because if I have a bias, in this case a bias to the upside, then I'm expecting pullbacks will unfold and end after 3 waves, and that rallies should be in 5. So therefore, I'm finding where I am within this unfolding series of movements. And if I know where I am, I have an idea of what should happen next, and that's the whole goal. Now, why do we think it's patterned? And I'll let you read what's on the chart. I'm going to talk about the emotion maybe that a trader might feel during each of these waves. So a market, again, has been declining for some time. It reaches a bottom. There's an advance. Most people will say, well, the larger trend is to the downside. Therefore, this is a bounce within a bear market. Therefore, an opportunity, perhaps. If I looked deeper into the data, maybe clicking down to a shorter-term chart, and saw that wave 1 actually unfolded in 5 waves, from an Elliott wave perspective, I would reach a different conclusion. There should be a corrective setback, followed by at least another 5-wave rally. Remember, I said even corrections unfold in 3 waves, so if the first leg off the low is in 5, then I expect a correction and another leg to the upside to finish 3. The market starts to pull back in wave 2. The crowd is going to say that's the resumption of the bear trend. I best jump in right here. From an Elliott wave perspective, if the subwaves are in 3, A, B, C, and it does not go to a new low, I'm going to be looking for another impulsive rally, a rally in 5. So while the crowd is thinking, move to a new low, this is my last and best chance to jump in because I've missed the entire decline to date, we're looking at it from a totally different perspective, saying even if the rally is going to unfold as a correction, ultimately it has further to go first. So we get a wave 3. When wave 3 exceeds the top of wave 1, a few people will note a breakout, and they will say to themselves, oh, a higher high, higher lows, basic definition of a bull trend or an advance, maybe the opportunity is the upside. We'll see sentiment increase during wave 3 from very bearish moving to bullish as it extends, because wave 3 is often the longest and most powerful wave. It unfolds in 5 subwaves as well, and it should be your longest wave. Doesn't have to be by rule. The rule is it cannot be the shortest of the 3 impulse waves, 1, 3, and 5. Just the other day I came across a count where wave 3 was shorter than wave 1. Therefore, I had the expectation that wave 5 would be shorter than wave 3. But in most cases, wave 3 will be longer than wave 1 as traders recognize a change in trend and they try to jump aboard. Sentiment will typically peak near the end of wave 3, reach very high levels. The people who have not gotten in yet will say, on the next pullback, I will. So wave 4 begins. Those that acted near or late in wave 3 will find themselves underwater. So, and there'll be in wave 4, an A down, a B up, a C down. When that C occurs and moves below A, you have lower lows, lower highs, starts causing some concern above the latecomers to the bull side of the market. They may dump their positions and move on out at just the time after a 3-wave setback that the market is bottoming and starting to move higher. Wave 5 then occurs, moves to a new high, and once again, I have another new high. So I'm going to jump in on the breakout. But the wave principle tells us, since movements unfold in 5 subwaves, that that's the end of the rally for now. But because there is 5 waves up from the absolute low on the left side of the chart, there's going to be just a correction, not a return to the bear trend. The correction will present the opportunity. Here we see a 3-wave correction, and here are some reasons of why it occurs and what you might expect to see. But mainly, as I explained, wave A down, maybe that's not a concern. B typically recovers about 61.8% of A. There is a pattern that allows it to challenge or even move to a slight new high. And then wave C comes down, and if it does challenge or break out to a new high, of course, that's a trap. The market will suddenly turn the other way in wave C, and when it breaks wave C, as I said, breaks below the bottom of what would be wave A, lower lows, lower highs, and concern will set in. people will turn bearish again just at the time that we see a three-wave corrective setback pull back. Now, I mentioned that within this overall pattern, there are sub-patterns, and all of them are corrective in nature. So waves 1, 3, and 5 will always be in 5 waves, and wave 2 and 4 will be in 3 waves. But when we talk about 3-wave movements, there are different types, and I want to just touch on an example of each of the 4 types or categories. The most common, the simplest, is the zigzag, and that's what you've been looking at. That's an ABC, where wave A unfolds in 5 waves, B, because it's counter trend, in 3 waves, and wave C in 5 waves. Wave C is often about equal to wave A. Wave B does not challenge typically the origin of wave A. That's a zigzag. Now, you could have a double zigzag where after the ABC, there's a 3-wave bounce, and then another 3-wave decline. That's a double zigzag. We would label the bounce as an X wave. And we can go as far as a triple. So you'd have an ABC, a bounce in 3 waves for an X, an ABC, a bounce in 3 waves for an X, and finally, one last ABC. What would that look like on the chart? While I'm putting labels on it, you would just say that's an overlapping decline. That's usually the typical definition of a corrective movement. It's overlapping. Simply put, it's a mess relative to advances or impulse moves in a bull trend, which unfold very steadily. Day after day, if we're looking at a daily chart, most days are going to close a bit higher. Pullbacks are going to be shallow to sideways. There's the double zigzag I mentioned. Now, I mentioned earlier, too, there is a corrective pattern that allows for a new high within the correction. Or, and I'm talking in the case of a bull market here. For a bear market, you simply invert everything I'm saying. So there would be a new low, possibly, when we're looking at a flat correction. Let's take a look at what I mean. Here's what we call an expanded flat, because wave B does move to a new high. Notice that wave A, when you look at the right side of the frame, wave A unfolds not in 5 waves like a zigzag, but in 3 waves. Typically a bit too shallow, we think, to represent the entire correction, though it could. Wave B then rallies to match the prior high or just above, but it too is in 3 waves, not the 5 waves we would expect an impulsive movement. And then wave C in 5 waves, normally ending below wave A. I often see these patterns around the time of Fed announcements, decisions on interest rates, after FOMC meetings. Many times during the day, on a small degree, there'll be a push to a slight new extreme, but it's in 3 waves. And in the hour or so before the announcement is made and the decision announced, the market will come off enough that I know that move to the new extreme was in 3 waves, so I can expect to see a flat. A triangle is nothing new if you follow technical analysis. It's a consolidation, simply put. Elliott gave it a bit more definition. Elliott suggested that within the consolidation there would be 5 waves. Each wave would unfold in 3 subwaves. So basically you have 5 sideways legs, all of them labeled A, B, C. We label each of those legs A, B, C, D, E. We can put trend lines across A and C and B and D, and typically they're converging. There is a case that they could diverge, but it's unusual. In the 25 years or so that I've been doing this, I've only had to do that a couple times. So I tend not to draw much attention to that. We're looking for converging trend lines. The final is what we call a combination. And simply put, that's when you have just that, a combination. A 3-wave movement, in this case it's a flat, a recovery in 3 waves, that's an X wave, I mentioned those earlier. And X waves can take the form of any corrective pattern. They can be a zigzag, a flat, or a triangle. But in this case I'm showing a zigzag, and then you see a triangle. But again, it's a corrective pattern. In its entirety, and this is a complex pattern, probably the most difficult, because when you get to the end of the flat, you might think the correction is complete. The subsequent three-wave rise in what's labeled X tells you it's not. But overall, you're going to see sloppy, sideways, overlapping movements. And that is the definition simply of a corrective movement. It's a mess compared to an impulse wave like 1, 3, or 5. So that's the wave principle. We've only been at this a few minutes, but that's the basics of it. There were 3 rules. You might have picked up that I said wave 2 does not retrace more than 100% of wave 1. That's what I mentioned. There's been a rally. There's a pullback. It's in 3 waves that ends above the origin of the prior rally. So wave 2 never retraces more than 100% of wave 1. It can retrace 100% for a double bottom, but never more than 100%. We talked about wave 3, and I was asked a question about wave 3 typically being the longest, and that is true. Wave 3 is typically the longest, almost always, but not. I won't say that is completely true, but almost always. Wave 3 can never be the shortest of the 3 impulse waves, waves 1, 3, and 5. It'll be at least longer than one of those. And finally, and I did not mention, but ideally wave 4 does not enter the price territory of wave 1. That's it. 3 rules. There are a handful of guidelines that help us along the way, and they're explained very well in the book, but we'll talk about a few as we go. I want to jump right into an example, because the best way to get a feel for something, to see if it's something that you want to research, you want maybe pick up the book and look at it, is you want to see how I would look at a chart. So here's an example. This is Aussie dollar on a 15-minute basis. Based on the brief description I've given you, looking at the decline from just above 94 to the low just above 92, do you think that decline, based on the description I've given you of corrections and impulsive movements, do you think that decline is corrective or impulsive? Now, I can't see your answer, but I think it's impulsive. I remember I mentioned that in an impulsive movement, day after day, or better put, bar after bar, is typically going to be in the direction of the trend. Corrections are a messy sideways affair, much like this, what I'm circling now, even this down here. Notice the middle of this move. It's very steady to the downside. It's an impulsive decline. Here's an idealized example of an impulsive decline. Here's how we label it, 1 through 5. And from the very beginning, what happens after a 5-wave movement in either direction? If it comes from, and in this case, assume that 94 is a significant peak, at least on this time frame, what should happen next? After a 5-wave decline, there should be a recovery, a corrective recovery. You can see the beginnings of it right here. Dan's mentioning it should be a 3-wave corrective recovery, and that's exactly right. There it is. This is a real-time example. This is something we counted in real time. So these are the charts that I was displaying online to the readers of my work. So there's a 3-wave rise. I mentioned earlier that the upward legs in a correction, wave C, wave A, are often equal. This short blue line is where they would have been equal. Notice how close we got, within pips. That's close enough for government work. Also, the wave principle goes well with Fibonacci, or Fibonacci goes well with the wave principle. We often see that corrections retrace 61.8% of the prior impulsive movement, or 38.2%. The key for me, though, is that the wave principle tells me where I should do my measurement from and to. And I think when you hear people talking about Fibonacci, that's where mistakes are made. You have to know which wave in price action is being corrected. And the wave principle, because we're counting these 5s and 3s, that's what we're looking for. Len is asking again, could we have a 3-wave move followed by another? And yes, that would be, say you had an ABC, and then an X wave, another ABC, would clear the way for yet another. That's one of the double or triple zigzags, or it would fall into a combination. But let's continue with this example. here's how we labeled it. 5 down, 3 up. What should happen next? If I knew nothing else about this market, what should happen? I have 5 waves down, 3 waves up. What's the next move? Well, since I said that even corrective patterns unfold in 3 waves, and I have a 5-wave decline from the high above 94 to 92.37, that can't be a correction. That is, if the decline is going to prove corrective, that's only the first leg, wave A. The recovery in ABC would be B, so I should see another decline. The shaded area shows what we just looked at. Look what followed. We did decline, or Aussie did decline. I'm going to jump ahead and ask this question. Looking from above 94 down to just above 90.5, do you think that decline in its entirety is impulsive or corrective? Remember, I asked this because my whole job is deciding, is that movement that is on, or is the movement that's unfolding on the chart in front of me, is it impulsive or is it corrective? That's what I do all day long. That's what the wave principle asks you to do. Most are suggesting it's impulsive. I think you're right. Even if you were wrong, and I'll take a little tangent here. Let's just say from that point, 1 and 2, you're looking to the downside anyway, because even a correction would unfold in 3 waves. So if Aussie had held, declined to this area, 91.5 or so, and held steady there, that could have been the end of an A, B, C correction. But you'll notice it didn't recover from that low in 5 waves. It did it in 3. There's an upward leg, down, up. Furthermore, it continued to consolidate. Think back to the picture of the triangle. Converging trend lines, right there and there, signaled that this was a correction. Since it did not overlap wave 1, it's probably, and after wave 3 was much longer than wave 1, I'll count it as wave 4. So I'm looking for a fit. I didn't mention this before, but as a guideline, thrusts from triangles, and that's what I mean by this move down from a triangle in the 5th wave, thrusts from triangles are typically terminal movements, which means they end the larger Elliott wave sequence. If wave B of a correction took the form of a triangle, the wave C, the thrust out of it would be wave C, and that would end an ABC movement. In this case, the thrust from the triangle finishes a 5-wave movement. Based on that rule, I would not expect to see a triangle form as a second wave. Those are going to be zigzags and flats for the most part. Yes, triangles typically form one move prior to the terminal movement or ending movement. So that's going to confine them to 4th waves and B waves. If I'm doing some sort of combination, they can be the X wave as well. What should happen after a 5-wave decline? Remember, it can't be the end of the correction. It can be the first wave of the correction, wave A, but it can't be the entire correction. So that signals there should be a rebound and another leg down. Here's what unfolded next. A very deep rebound. It moved through the equality measure and also the 618. But the patterns is what's important. Price is more important than any measurement. We had a rally, a setback to a much higher low, and another rally. Notice here that within wave C, you can count 5 waves. 1, 2, 3, 4, 5. So you had the indication that the ABC movement was nearing an end because wave C, once it cleared above this peak, just above 93, it should be near an end. And also, if it's a correction, it should not go above 94.07. So you had an opportunity there where you knew we're very close to where the market shouldn't go above the origin of the prior 5 down, and within wave C of the recovery, I can count 5 waves up. Therefore, that correction is near an end, and there's probably an opportunity there. What should happen next? After a 5-wave decline, a 3-wave recovery, I can say, well, we're in a bull trend. And since a correction doesn't unfold in 5 waves, that 5-wave decline is just the first wave of some larger movement to the downside. Now that I have the correction, I should see another decline. And that's exactly what occurred. Notice that the second decline from C down to this blue line, that's where they're equal. And that's where the decline ended. We had from the top then a 5-wave decline, a recovery, and then a very sharp, I'm going to call it impulsive even though I didn't put the labels on it, 5-wave decline we'll call it, and that's the C. It ended very close to equality. Since wave 3 did not extend, as soon as this rise moved to 5 waves, at this point we can count 1, 2, 3. It did go sideways here in 4 and then made a 5. That signaled that the entire movement was likely over. There was an upward move going underway, and in fact, from this point forward, Aussie dollar did go back and retest its high. But I wanted to go through this example because it shows all the basics of the wave principle. It showed the rules in action. It showed that we're monitoring price. There's a question about time. Personally, I don't follow time. I know plenty of folks who use the Fibonacci and apply that. So if wave 1 lasted 13 bars, maybe wave 2 will go either 5 bars, which would be 38.2%, or 8 bars, 61.8%, and they mark those on their charts. I'm not saying that it's not helpful. I haven't done any studies in that regard. It may be quite worthwhile to do those. I'm happy enough with knowing based on price where the market is within its sequence and what that means about where it should go. So I'm just going to look back. Any questions? There was a question about that you cannot know unless the movement was finished. I'll rephrase that, and if we think back a couple charts, go back just this one here, there was a 5-wave movement. So you had a good indication late in what you expected based on knowing the basic pattern that after 5 down, 3 up, or 5 down, there should be a 3-wave recovery. And we certainly had it. Any time wave C crossed above A, you had 3 waves. But because we can look at multiple degrees of trend within the same market, in wave C, we could count 5. Until then, we didn't think wave C was over. It was only after it crossed above, and this looks like maybe 90, 93.10. Only once it crossed above there did we think the move was coming to an end. I don't have the chart in front of me. It would be interesting to go back and just drill down on this final 5th wave. Does it have 5 waves in it? Did it subdivide? I can see a 1, 2, maybe there's a 3, there's a pullback 4, and then the high, 5 waves in 5. Top-down analysis. That's exactly the way I approach it anyway, when I started all of this, I was working off daily and weekly charts. This was before the internet. I didn't have charts in front of me like this. I was working off daily and weekly charts. The chart book would come in on Monday morning. I would stand in my booth and I would page through looking for on a daily chart sequence or page, can I see a 5-wave movement coming to an end on this chart? If I can, then there's an opportunity. If it's a rally, the next opportunity is to the downside. If I could see a 5 and 3, then the opportunity was to rejoin the trend. So for me, and I still do this to this day, even though there's so much available free data out there, I still start from the top down. I want to know what my bias is. Which direction is the market trending? I prefer to act in the direction of the trend. So I will start, even though I'm doing updates throughout the day on a very short-term time frame sometimes, I'm always referring back to the larger trend. Since, in this case, Aussie is in a bear trend, signified by the 5 down, yes, I expect a recovery. I also, so that's looking one move ahead, looking 2 moves ahead, but I also expect that recovery to prove corrective. So having an idea of the trend on a larger degree gives you more than a hint of what you can, how that movement should unfold. If I believe it's going to be a corrective, I'm looking for the zigzag, the flat, or the triangle, but I'm looking for 3-wave movements. Interesting question about fundamental news. Just yesterday, there was a small event, a little announcement by central banks injecting some liquidity, and certainly you saw the dollar plunge on that. What was interesting was the prior day, I was looking at certain pairs, dollar CAD, Aussie dollar, for instance, that were showing that the dollar had declined from a high in 5 waves. And that was a signal that perhaps the dollar correction, and that's what I was calling for, was just a correction, had more to go. When I sat down at my screens, the announcement had already been made. The dollar was down substantially. But looking at the chart, just invert this picture that you see on this Aussie dollar chart, and that's exactly what I saw at that time, a 3-wave movement. In sterling or in cable, the recovery was in 3, and waves C and A were within pips of being equal. That was true of 2 or 3 pairs that I follow, that the recovery of the dollar's competitor was in 3 waves, and this is after the surge, after the announcement, and the upward legs were equal. So the pattern told me corrective. The measurement said the market's sort of where it should be if the correction is going to end. And you know what? That's where the market held all day. Now, it didn't come off its lows by much, but it held. And those extremes registered after the announcement yesterday, before I came on with you here today, was holding as well. So it's not somewhat, the question is, and we get that discussion all the time in the office, the question is, did the announcement move the market? I think not, simply because I had patterns that suggested the dollar decline had more to go anyway. So to me, the pattern was evident before the news hit. Now, what everyone else wants to hang the move on themselves and blame for the move, that's fine. But as far as I'm concerned, the wave principle sent me the message prior to the announcement that the dollar might have some more weakness to go. Another comment, interesting, about Swiss and dollar yen in the intervention. You've seen intervention work twice recently. I'll tackle dollar Swiss first. Dollar Swiss, after falling substantially in just a spiking fashion, a waterfall decline on your daily and weekly charts, suddenly bottomed, advanced rapidly and did so in an impulsive manner in 5 waves, and then it pulled back. And the pullback was in a flat, so it was a corrective movement. Lo and behold, Swiss National Bank jumped in right at the end of the flat. Do I give them credit for the rally that followed their intervention? Absolutely not. If they would have done nothing, dollar Swiss, as far as I'm concerned, would have rallied. The wave principle showed me 5 up, 3 down. The expanded flat was very well formed. I think they simply got lucky in their timing. So basically, I don't have the chart of this because I'm just answering questions, but basically what happened there was they acted at this point. If we turn this chart to a bull market example, they made a decision and announcement at this point, when dollar Swiss was poised to move anyway. Okay? Second example was dollar yen. The Bank of Japan had intervened 3 times in the months prior to the intervention that worked. What they did, though, was intervene at the end of an impulsive decline. they basically just got it right. They looked a little bit smarter than the Swiss National Bank because they, instead of getting in at the bottom of a correction, they timed it to the bottom of the wave principal. Maybe, just speculating here, perhaps they have a technician on staff that knows a little bit about the wave principle because they timed that one just right. Could be luck. Could be something else as well. I don't know. But that's when I see intervention work. So again, is it the intervention that causes the trend reversal? Or is the market just naturally ready to turn anyway? I contend the market is just ready to turn anyway. There was a question about, can there be a 3-wave move up and 5 waves down? Well, that's what happens within a movement. In the case, I'm going to stick with this Aussie chart because some of the questions I'm answering, I don't have the charts for those. All right. So in this case, you have a 5-wave rally, or 5-wave decline, Aussie dollar, a 3-wave recovery, and then you're going to get 5 down, a sharp move for wave C or 3. And no one has asked this question, but it was mentioned in the intro that it takes some practice to use the wave principle, and that's true. That's true of anything. It takes some practice. And you want to look at the wave principle, if you take the time to do so, with an open mind and see if you see the patterns. For me, when I did this long ago, I read the book a few times. Actually, the first 2 chapters tell everything you need to know about the wave principle. I'm still using those tools. And so it's maybe 100 pages. And then you need to start just looking at charts and saying, do I see these patterns? When you see a 5, follow the market and see if it pulls back in a corrective manner. You know, if it's a 5-wave advance, look for a corrective pullback. If it's a 5-wave rebound or 5-wave rally, then look for a pullback. With a 5-wave decline, look for a rebound. Does it occur? After a while, you'll be looking for 5s and 3s everywhere. I see charts of employment data, housing sales, whatever. My eye immediately goes just looking for this simple pattern, 5s and 3s. Again, this setback here, 3-wave movement, downward waves about equal, just with that little bit of knowledge, that was enough background in the wave principle to suggest this may be a major low, and we're going to go back to a new high. So one topic I want to touch on before our time is up today is, and I'll go back a chart, at this point, you may not know, because I did not show any charts to show what was the even larger. We're looking at a 60-minute chart here of Aussie dollar. I don't know. I'd have to look at, say, a daily or a weekly to know how does this fit in. But unless this decline ends a corrective pattern, which we know here it doesn't, because 94, we started with the assumption that 94.07 was a significant high. There's a 5-wave decline. That's the first move of a larger downward sequence, whether it be A or 1. There's a 3-wave rebound, which was expected. That's either B or 2. So some folks will now argue that, well, you're following 2 different counts. So there's confusion. And I would say you look for the common thread between counts, because I'm often juggling multiple wave counts, possible wave counts. Because of the way the guidelines are being adhered to, I may favor one over the rest. But if I'm juggling 2 counts, as I could be here, this could be a 1, like the idealized chart shows, and 2, or I could replace those with A and B. Both counts tell me the same thing. Aussie dollar, or any market in this position, should decline either in wave 3 or in wave C. Both of them call for a move, at least as long as the original 5 down if it's an A, and if it's a third wave, it's going to be likely longer, more towards a Fibonacci 1.618 times as long. But until Aussie were to move below 90.61, I would be bearish this market without question. As it moves down off of the top of the correction, you get into how do you handle this in terms of trading it, and positioning. And what I'd like to do is invite you, if you're interested in the wave principle, if you think it's something that you want to research a bit that could add to your tool bag, I use it, and that's all I use, but some people use it in conjunction with other things. If you're interested in that, we're offering a 14-page ebook, and that's going to show a little bit or give you ideas of how to turn what's not a forecast but a roadmap into a forecast that'll help you possibly in your endeavors. All you need to do is go to this website you're seeing here, request the ebook, and we'll also offer, part of the offer will be, and this we haven't done this in years, we'll give you a free trial so you can see exactly what I'm doing all day long and what my peers are covering. We cover currencies around the clock and what they're doing through my evening. So I invite you to start your research there, but definitely Frost and Prechter's book is what you need to read. Everything you need to know is in the first 2 chapters. Those chapters cover just under 100 pages, but we're technicians, so there are a lot of pictures. Takes up most of the page. This is very visual, so if you're a visual type learner, this is excellent for you to look into. Read those chapters. You probably have to read them several times. Look at the ebook. Look at what we're doing in real time. And just let us know what you think about it. I'd like to thank everyone for listening for the last half hour or so. I surely appreciate it. And with that, I'll hand the mic back over.
Thanks a lot, Jim, for the excellent webinar, for the instructions and the enlightenment around the Elliott wave theory, also for the kind offer that you have made to our visitors, to our attendees. I think this was a great session, also great participation from our users, excellent questions, and I just encourage you to learn more about Elliott wave. Even if you are not going to use it finally as the only tool, but the insights you gain from this theory will completely change the way you understand markets, generally speaking, in prices and everything related. I thank you again. Thank you, Jim. Hopefully we can see you someday again here at xtrade.com webinars. And have a nice week all. Thank you. Bye-bye.